if you're out there, you have a thought or an idea or a question, put it in, get it out to us and ask it. It makes the program a lot better because you have the thought, 10 other people in the audience had the same thought. The only thing we'll ask is that you keep it short and to the point. And with that, I'm going to flip it over to Chip and let him introduce himself. So Chip, why don't you take it away?
Good morning. Chip Perkins, as he said. Marty, thanks for having me again. I appreciate it. Thank you. Yeah.
Just use.
Oh.
So you don't need to do the square. It should.
Into the square.
Okay.
I'll get a little closer.
Speak up.
There you go. Over there. Okay, we'll start again. Chip Perkins, Perkins Fund Marketing. Just thanking Marty and Akerman for having us today. My business is that of a placement agent, or as some would term it, a third-party marketer. Been doing that for 26 years. My firm is a registered broker-dealer overseen by our friends at FINRA and the SEC. And all my people are registered and legal across the country. We've also, in the past, been registered in Canada. Haven't seen much activity there of late, so we backed down on that. We do some work in Europe, but as you know, we have to be invited these days. You can't just run over there and start knocking on doors. Used to be great. So what we do is select managers. We listen to our clients, our investors from across the country, and find out what they're interested in and try and find it. I don't know if you guys are aware, but people actually have long-short equity in their portfolios. So we don't concentrate much on that unless they're unique or niche strategies. But we've had everything from mortgage backs to long-short credit to real estate, really across the board in all alternatives, which is what we traffic in. And we've raised north of $7 billion for our clients. With that, I'll turn it over to you.
I'm Paul Foley. I head up Akerman's investment management team nationally. We represent over 400 managers all over the country, really of every shape, size, and strategy. We also represent a number of family offices and institutional investors on the legal due diligence of their funds, the fund investments, as well as if they're multifamily offices, helping them register.
You should speak into the microphone.
I don't
Pick it up, man. Sure.
pick it up. All right. Well, so we work with a lot of family offices on the fund due diligence, as well as multifamily offices with registration, those kinds of things. We really touch every area of the country, but also really every strategy. With that, I think we can get into it.
Yeah. Mark.
Well, great. Well, thank you, Paul, for that. And thank you, Chip. Chip, I'm going to toss the first one your way. We just heard the last panel, and obviously the economy is a big thing. It impacts, appetites of investors, and certainly they're going to invest where they think there are opportunities to make money. So there's a lot of uncertainty in the market, as we heard from, Corey, Michael, and others on that panel. So just give us your impression right now, or what the implications are for family offices and managers. What's this going to mean moving forward?
Well, I think that family offices and managers are feeling as uncertain as those three gentlemen were about what's going to happen in the future. I don't think anybody has a crystal ball. But what I'm seeing is a little more hesitation to put money to work right now. And a look for market neutral, non-correlated, niche strategies, things they don't have in their portfolio now. I have one that's worked out pretty well this year. It's small fund, but it's electricity trading, and they're up 51%. I don't know anybody else that's, well, a few guys are up that much, but it's, it's just very different than it was 10, 15 years ago. And people have a lot of core alternatives in their portfolio. So they're looking for something different, something that can add value, add some alpha. without having to, put too much risk on the table.
So would you say that the market, maybe 2-3 years ago was very much a seller's market, and today the pendulum is beginning to swing back towards a buyer's market? I don't think it's fully there yet, but would you say that's the general momentum right now?
Well, I would say that people are being careful with their investments and their desire to put money to work. They have put a lot of money over time with the big names in the hedge fund business. Some of them, especially on the macro side this year, have been able to perform very well. But people are searching also for new macro guys. The problem is with $100 million or $50 million or $200 million or even $500 million, how do you really get a diversified macro portfolio? So those guys need people like me that can help them find clients that will believe that they can do it when they have more money and can be in all markets. But it's a very difficult thing to do. Just pick the next Paul Jones. Just not a lot of them out there.
Sure. So, Paul, you heard him say that managers are being more careful now, or I shouldn't say managers, I should say investors are being more careful now with who they invest. How does that impact the conversations you're having with them? Having between, when you step in, helping an investment manager or helping an LP make investment decisions, what are the implications of that from the legal perspective?
Well, just at a higher level, what we're seeing as far as actual strategies that are being launched now, it has really changed over the last 6 months. I mean, there was so much going on the venture side, and now that is really dried up. And I know Chip's going to want to talk a little bit about that. I don't want to foreshadow that too much, but the venture side of the market is a really interesting side of the market, but it is not nearly as hot as it was. We're starting to see some cooling on the private equity side from just a fund launch standpoint. And Chip's right. We're seeing uncorrelated niche strategies being launched. We're doing some really interesting legal funding type, NAS tort funding type funds where you can actually own a law firm in Arizona, like a fund can own a law firm in Arizona and then partner with other law firms. It's really the first time a lot of this has ever been done. Some patent troll funds, really just some really interesting things. Direct lending has become really, really heated up. Build to rent, we're doing a lot of build to rent, like where they're building a whole subdivision of single family homes with the whole idea just to rent it out. So we're seeing a lot of neat things. And then the other thing that's back is active equity management. Like a traditional hedge fund managers, we're seeing them actually launch and wanting to come to market now. And I think that's something I hadn't seen in a long time.
Sure. And let's just switch hats a little bit here in terms of, from a regulatory perspective, how is the Biden administration approaching the private markets?
So we've seen a real ramp up from the SEC. We've seen the exams really get a lot more aggressive and more frequent with respect to a lot of the managers that are out there. I haven't seen the increased enforcement yet. I'm not sure. I think that is coming, but we have not really seen increased enforcement. I'm dealing with a few decent sized enforcement matters right now, but that's pretty typical. It's not like they're just so many that the SEC is really trying to get everybody. But I think the red ripple, I guess, for this last election type thing, where I think that's going to embolden Gensler and the SEC to be a lot more aggressive over the next 2 years with respect to a lot of these investment managers.
Yeah, when you said the recently, are you referring to FTX?
Oh, the red ripple. I was just talking about the election. It wasn't a red wave. I don't know exactly what it was, but sorry.
Fair enough. Thank you. Go on, Chip.
I would just say that the market itself has changed the compliance requirements that FINRA and the SEC have put on fund managers and even small shops like mine is intense. It's caused a lot more expense. It's caused a lot more fear in the market. Year over year, the last few years, fines are up across the board. FINRA's making money, I think, off of its members. And I think that that's not going to stop with the current administration. I think that, we, for one, won't work with anybody who's deemed a retail investor even if they have, 20 million bucks and have been investing in alternatives for 30 years. If they don't have 50 million bucks, they don't qualify to work with us now because of the fear of FINRA and how they're treating retail investment.
So how does that work? So can you take a deeper dive into that? Or,
No,
no?
I can't. It's really not that interesting.
Well, yeah, it's probably not that interesting.
You do it.
Well, you have to be equipped and you need to be a sophisticated investor in order to lower the thresholds from FINRA's regulatory scrutiny standpoint. FINRA is a lot different than the SEC. FINRA regulates the broker dealers, and FINRA is a lot less political, but they're hostile, I would say, for lack of a better term, towards smaller firms. The way that FINRA is structured is really geared toward major bulge bracket brokerage firms, and they basically, their enforcement process, if you end up in it as a smaller broker dealer, you're going to go. On the SEC side, on the investment advisory side, it's a lot different, but there is a lot more political pressure there, and that's where I think we'll be seeing a lot more of the enforcement over the next 2 years.
Chip, you've been around for a while raising capital. You've seen changes in the economy and how things have impacted and worked out in the past. So from 2000, 2008, what are the lessons learned for those who are raising capital? That apply to today, if you would, obviously they're past lessons, but how does that impact your thinking today on that?
I mean, we've been doing this since 1996. So what we've seen is, and I think we've always done a good job at it, but increased requirements for due diligence. You've got to really dig deep and do a thorough job. And we've actually gotten accommodation from FINRA because they like the way we do due diligence and the records that this is not me, it's my partner, Linda Champagne, who is able to do all that stuff. Her job is to keep me out of jail. And unfined. So just the amount of work that you have to do now and the trust you have to build with your investors, because all we can do is search for the best managers we can find in a strategy that people want to buy and do the work on them and the background checks and everything so that we're then trusted by the investor. And it's a process that has it takes more time and more effort and more money. But in our business, if you bring out a bad guy, you're pretty much done. So that's what we spend most of our time on, is finding good managers and digging deep. It used to be, you'd meet a guy at a bar and you shake hands and he'd say, "Oh yeah, I'm a hedge fund." Great. Well, I sell hedge funds. Well, that doesn't work. It's really become a very important part of investors' view and due diligence is the due diligence that we do first before we present something to them. And they can build on it. If they want to come to our office or whatever, we'll share the due diligence that we do. I don't ship it around because it's a little bit proprietary, but there's a lot of work that has to be done on managers before you can bring them out to people. And there are thousands, as you all know, of managers that want to suck up your time. And get in the way. So if you work with a, whether it's consulting firm or a firm like mine, you've got to check us out the same way you would check out a manager first. But then if you look at what we do and the kind of work that we do, it's value add to what you're doing. So I think those are the biggest changes from back then.
Do you check out as part of your due diligence process, the other investors that are, who they're approaching, what their approach to market is, but also more importantly, who the other LPs are likely to be?
Well, that's proprietary information on the part of the manager. If they're willing to share it, that's fine. But again, if you're overseen by the SEC, you're not really supposed to share a lot of information. But we know a lot of the names of people that go in. You certainly talk to the references, anything like that. But what we try and do when we help a manager build a portfolio is not get, Bigfoot in the room. You want to have everybody have a certain portion of a fund. So if you're raising $100 million fund, you don't really want one LP that's got $70 million. It's not good for the manager. It's not good for the other investors. So it's a balance as you put them together, and who these guys are over time.
One of the things that I'm going from the audience.
Yes, I've got a couple questions. We're a single family office and we deploy capital in the same size as an institutional. I want to ask a question to both Paul and Chip. For Chip, are you seeing any differentials in the venture capital space funds as these VCs are registered as RIAs now? We did not re-up on Sequoia just because of the new structure that they have, and they've also had a huge management change. But they're not the only ones that are registered RIAs. That's one. And then the second one is we have issues because a lot of LPs in the fund under CFIUS is causing compliance issues. And it's a drag in our deployment on our capital. So are you seeing issues and are you structuring funds or doing due diligence prior to that? So those are two questions. And I don't want to take up other
No.
time.
So on the CFIUS and OFAC, I mean, we're running into all kinds of interesting issues. The OFAC side, I know you can specifically ask about that. If you have a Russian national who's even an investor in the fund, and then you're a service provider to a fund, it can create some issues. And really looking into those issues for fund administrators and as well as the fund managers. There's a number of fund managers in the U.S. that are just ignoring it completely. On the CVS side, it's a little, that's a really bad idea. So, head in the sand is never a good idea. On the CVS side, I mean, that tends to be more specialized, and I think those firms are really smart to be really on the front end of that. But a lot of things are getting denied. What we're seeing as far as deals and getting approvals done on things we thought were going to be done deals. So that's a different animal. Now, I know you asked about venture capital registration. So the good thing is for pure, real venture capital firms, you don't actually have to be a registered investment.
No, they're taking the exception. So a lot of the ones that are now registered as investment advisors is so that they can do a workaround and deploy capital outside of the VC mandate.
Exactly. Yeah.
So I'm asking you a question, are you saying more?
Yeah, absolutely.
I don't want to get out of
Yeah, actually, and back to would Sequoia have expanded and become an RIA?
There's a bunch of them.
And I think so. Did Andreessen Horowitz also? Because they all wanted to invest bigger.
Well, they want to invest bigger, so a lot of them want to do secondaries. That's a big space that doesn't fit within the venture capital exemption, or they're just getting broader out there. And some of these structures are not particularly investor friendly that are coming out of Silicon Valley, and so I think
that's why it was a Phil.
Yeah, well, I'll give it right back to Phil.
Chip.
Sorry.
Not Phil.
I'm sorry.
You know me.
I know him. I'll just listen to you, though.
I think, unfortunately, that a lot of these firms, and I'm speaking from, this is my own opinion, have gotten so big, and the partners have gotten so wealthy on their own that they are looking for ways to increase their wealth. And a lot of them don't really need you guys anymore, to do the things that they want to do or the future that they want to create for themselves and their firms. And I think they're also worried about how their performance is going to turn out. And, I've had over the last 5 years, I've been flogging a fund that, has a 7% dividend, but it's a 5-year lock and, it makes about 11%. And everybody says to me, I always get 20% on locked up money. Always. Why would I do 7 or 10? Forget about diversity, but I think that there's going to be a big shockwave in the private equity and the VC space that is going to be very negative, and people are not going to get their 20% necessarily, because people keep, if you're a venture capitalist, who are you selling those companies to? Because you do have that 10, 12, 13-year clock. You got to give people their money back at some point, right? At some point, the biggest whale in the room is going to own it. And where are they going to sell it? Or they're just going to push it back to you and you're going to own whatever it is. So I think that there's a crisis that's going to happen over time.
I see somebody waving his hands from Helios Capital Advisors. Do you want to chime in here with a comment or a thought? No,
He was waving. That's
He
all I
was
wanted, he was waving.
okay. Well, actually, I don't know if Will Stringer is on or not, but Will is a very early investor inside of companies, particularly venture-based company. I'd like to get his reaction to what you just said, Chip, if he's available. I don't. He's away. I think we'll move on.
Though.
He does, doesn't he? So, Chip, one of the things I wanted to go on and have talk to you. We spoke about due diligence a little bit earlier, and particularly around hedge funds. We know there's people that write great research papers, and do great analysis, but when they finally get to be the CIO, they now they're in the seat of having to make the timing decisions and all that. So my question to you is, when somebody is transitioning from that researcher analyst and now they're going to be the CIO on the new fund, how do you diligence that? How do you look at that? How do you respond to that?
Well, I think you got to do a bunch of things. You got to look at their past and see, what did they accomplish? And, if there's any kind of track record that you can pull from the work that they did previously. You have to talk to the people that have known them over time. You also have to see what kind of a team they can put together. Because one of the worries that we always have with new guys is, if they're coming out of Goldman Sachs or whatever, and their computer didn't work, they just picked up the phone and Jimmy came in and fixed it while they had a cup of coffee, and then off they went. They don't know how to plug in a phone. They don't know how to build a business. And our concern and we do a lot with new funds is, can you run a business? Can you get information out to people on time? What's your track record working with people in the past? How long have you known the people that you're working with? So it's not just their investment prowess, because there's an awful lot of good analysts that have been, could become good portfolio managers easily. But can they run a business? Can they supply to their investors all the information that's needed? That's one of my biggest concerns.
I have a question.
Sure.
Mark, it's a real quick question. So there's been a lot of talk about how other institutional money is kind of left like the late stage venture capital stage. Do you have any thoughts on that in terms of do you see institutional family office investors just pulling back on certain areas outside of late stage VC, like private equity, real estate, or are people going into, are they finding, safe havens to invest in? Any thoughts?
You do listen to that last panel. Where's the safe haven besides government?
Silver,
Gold.
Bonds, gold, right? Not everybody's just going to buy gold and governments. So I think people are looking. I don't think that not a lot of capital is being raised this year or even partially last year, because people are trying to figure out what's the next step, what's the next thing to do. And I think that, an inordinate amount of money has gone into private equity and venture capital. And I don't know that there's that many people doing startups. I mean, there's a lot of startups, but there's so much more capital than there's startups in the VC business. And I, quite honestly, a lot of this is just my opinion and things I've heard. We don't do a lot of venture capital ourselves because we only take on 5 or 6 funds, and 5 of them are usually hedge funds. So that I need to put that out there first. Yes.
Chip, I can't speak for all family offices, but I just came back from, and I do the family office series of conferences that I get invited to speak at. So we do a lot of us single family. I can't speak to the multis, deploy capital globally, and so we're not just North America centric. And so we see a lot of opportunity, and we do look at funds. And outside of the US, obviously, specifically now we're seeing a lot of Southeast Asia, and the Middle East has been seducing us, trying to get inbound because of diversifying their country risk. So we do see direct investments, and talking to, I think, Paul, you mentioned about looking at direct lending. We do a lot of that. So as far as running from, there is, as you said, as the previous panel said, there is no safe haven. However, there is a diversification of risk. Do you guys see any of that coming out of other family offices?
That's fair to me. Yes. And we do, although we sell primarily in North America, we have funds, we pull funds from all over the world. I have a China fund from Shanghai. I've got, I've got different kinds of funds and managers from everywhere. I just don't select people in the United States. But we go and do the same due diligence. Although with COVID, we have not gotten to China in the last couple of years, and I'm not falling over myself to go back. But there is opportunity all over the place. I spend probably 3 or 4 weeks a year in Abu Dhabi and Dubai, in that area, looking at opportunities and meeting interesting people. But that answer your question? A little bit, kind of.
Thank you.
I'm trying. I want you to have.
Marco, last question.
Yeah, I was just going to say, we're probably going to wrap it up here. So, gentlemen, what I want you to do is maybe just to give your final thoughts on what people's takeaway should be today, and particularly think about, Paul, you're not in the business of recommending, but maybe you could both speak to what you're hearing for the appetites from your investor base, what they're looking for, what they want to, how they want to go, and what they say they want to see for themselves.
Sure. I really, from an investor standpoint, we represent some, Fortune 100 pension plans, as well as the family offices. And most of the Fortune 100 pension plans are really focused on the largest investment managers. And I'm not sure that that's always the best. I don't know who's seen the numbers that have been reported on the public side for Tiger. They've been less than impressive. And my understanding is that when the private basket there is marked to market, that's going to even be less impressive. I don't know that for a fact, but so there's maybe a little bit of a group mentality among a lot of the largest, most sophisticated investors that I'm not sure that's a great thing. But there's a lot of opportunities out there, and we're starting to see in various different pockets uncorrelated niche type things that you really hadn't seen before. And so sometimes that can be a little bit difficult to underwrite, but there's people who have long track records in these areas that really make a lot of sense. And because this is a manager selection forum, I just want to say, when you're looking at these different managers, I think it says a lot about who they've chosen as their service providers. If every one of their service provider is the lowest cost provider, that's a problem. If everyone is the Rolls-Royce, Ritz-Carlton, service provider, that's probably a problem too. And so you want to try to, and you know, speaking as a middle market attorney, you know, that's probably a little self-serving, but it's an interesting dynamic that you want to make sure that people have very good, competent service providers on that side, but not necessarily the low-cost providers or the highest cost providers who they're probably not getting the A team, the B team, or even the C team.
I would say, in addition to that, everybody wants to have well-known service providers on the masthead of whoever they're investing in. I think that, you know, one of the things that we spend a lot of time on is emerging managers, and there are, you know, if you're talking to a big pension plan, they'll tell you that an emerging manager, you know, has about 5 years in business, $10 billion under management.
It's not an emerging manager.
It's not, but they think it is. All of you should look hard at emerging managers. They tend to have better performance. They're more involved on a day-to-day basis. It's a smaller, tighter firm, and you know, things change when you get to be $1.5 billion, $2 billion often, and not everybody can do it. I mean, I had a manager that we took on at 100. They took over from us at $1 billion, and they're 5.4 billion, and they're doing great. But they're really smart guys, and they built a beautiful team. Not everybody can do that. So that's what, you know, I would say to close, Mark.
That is fantastic. A lot of great wisdom there. Did
Will,
somebody have
you
a,
want to?
I'm sorry.
I have a quick question.
Good, fire away, please.
My question is for Chip and also for Paul. So you said there's thousands of funds out there, which obviously there are. How fast does it take you to go through a process of elimination for about, let's say 90%, 80%, like 15 seconds, or? Because I get funds that come to me all the time. I'm like, okay, don't check it, you know.
Well,
they're too small.
We look at,
wrong.
it's not always too small. You know, for us, we'll look at, I won't look at the AUM first. I'll look at the team. I'll look at the service providers.
Okay.
I'll look at, you know, what they've done in the past. And then I'll start to look at track records.
What about the market desirability? I mean, if the market's not buying it at that moment, it makes it more difficult.
Well,
I mean, it could be a great strategy, but you know,
I've made that mistake. I thought that the convertible ARB would come back in like 08 and 09. And I, you know, pushed forward with my team, and I was so wrong. And now if you want to become one of our funds, everybody in the room has to vote positively about the manager. I have to have 100% buy-in because I'm not taking that risk again.
You also made a great comment about the fact that the manager can operate a fund, because it seems like funds today have so much more complexity, and on every stage. I mean, emerging manager to me is probably 50 million or above. It's not, it used to be 10, 15, 20 million. Back.
7.
Right. So to get to 50 million, it takes a certain amount of operational prowess. But a lot of fund managers can make mistakes. I had a guy who was managing 150 million. He says, all my agreements with my LPs were terrible in terms of fee structure. I'm not making any money. Right. I've got another fund who's managing 300 million as a sub-advisor, but they're probably getting, you know, 300K in fees from it because they're getting 10% of the 1% of the other managers charging, right? So,
It's scary. A lot of these guys do not know how to do math.
Yep.
And what you have to figure out, we do a lot of advising to funds just because we have experience in it. And we're coming up with them, working together to get new kind of fee arrangements so everybody feels that they're all at the same plate.
It's tough. Yeah.
You know, putting in hurdles and clawbacks and things like that, because not everybody can be Stevie Cohen.
Oh, but you also have to understand the waterfall there, don't you? How the money's going to flow out, because that impacts when a manager sees his dollars, right? If he's at the very end of everything, he may not see a dollar until year 7, 8, or 9.
You got to be careful of that because they have to pay me, Mark.
I understand, and that's what I'm talking about.
Wrong. No, I make sure my guys make money and that their guys make money, because if they don't, you know, I've wasted time bringing them out. I've got a black eye with my investors. It's got to work. So I can tell you, if somebody takes a seed deal at 20-25%, they can't hire me because I won't let them, because, you know, what, we have 45-50% of the money going to two outside sources, one guy who just gave money and one to raise money. You only got 50%. You know, you might as well go to work for, you know, Millennium or somebody like that and take your shot there and then you don't have to deal with investors and people like me. So I think that, you know, people get in this business not, you know, to save the world. They get in the business to make money and to make money for their investors. And if they're not, at the end of the day, when they do all the math and the division and everything else, they shouldn't be in the business. And you guys shouldn't invest with them because they're not, you know, somebody you want to be in business with. They're too dumb. They're not, you know, making any money.